Okay, welcome everyone. We'll start our lesson 3. Today is the last lesson regarding finance for administrative managers. And my name Anjum and my email address anjum@ukversity.co.uk. If you have any email and let's please, before starting, always it's good to be rate 1 to 10 yourself, your current knowledge. So what do you think at the moment, in terms of the purpose of accounts? Anyone, please?
Yes.
Okay, so a scale 1 to 10, we can just, check our current knowledge about purpose of accounts. So always good to be when we start any activity. So always good to be look around where I'm at the moment. And at the end of lesson, we can reflect again. Okay, so today lesson we have two assessment criteria, explain the structure and the purpose of main financial statement, and we'll go through and we'll interpret, how the financial statement we can use for decision making as a manager. Okay, so financial statement are there on their own, the limited use because it's not provide the information. We need to look around what purpose we are using these accounts and what sort of decision we are going to make or will make, on the basis of these accounts. So for example, if you were to identify the business has made the profit of 1 million, what does this tell you? Because business profit is not mean the cash, maybe the credit sale, we are giving goods away and we're selling, and maybe we're not earning actual profit. So we need to be make sure so we have made the profit of 50 million and their closest revival earned profit of 60 million. So that's we need to go through and we need to make the decision. So today lesson we'll go through the ratio analysis, how we can interpret these accounts. So that will be the key. If you have any question, you can ask. So type of business organizations, the not profit making organization and the profit organization. Like we discussed, sole trader, partnership, and limited company. Those are normally known as a profit organization, charity, NGO. These are non-profit organization. Their purpose is to welfare and not earn the profit. Okay, then we have a company's limited liability. Companies normally have a limited liability, and in the UK we have a Company Act, and in other part of the Company Act 1984. In other part of the world, lot of countries they have a Company Act 1984. So we can use these as a limited liability. So in case of if somebody can't really pay back their loan, so in the case of liquidation, so in case of liquidation, what we can do, we always have a limited liability that so bank can't claim against the personal assets. So that's why it's a limited liability. So in case of company have two types. One is called public limited company. One is a private limited. Public limited company in the UK need to be, if you want to register as a company public limited, we need requirement of £50,000 to show and register in the stock exchange. Then we can issue shares to the public. Otherwise, we can't issue shares to the public. Okay, there are two major types of accounts we prepare in under the financial statement. One is the statement of profit and loss. It shows how much income or expenses we have in a particular period. Then we have a statement of financial position, which shows our assets, our liabilities, our equity, and how much worth of the capital or the investment we have in the business. Okay, so next any question you can stop me, you can ask please. You can chat as well. So the share capital is mean the investment. Then the shares have a nominal value. Nominal value mean the face value of the shares. Maybe like if we look around Amazon shares, maybe £1.50 each when they registered share capital, but actually the value at the moment is quite high. Like Bitcoins and various other shares we can buy, and the coins like we can invest as well. And there was little value in the beginning, like $25, but now is $42,000 each coin. So the value can be market value can be different. So the shareholders can be two types: ordinary shares, those have a voting rights, and a preference, they get the fixed dividend. So ordinary will be paid after the paying the preference in case of liquidation, or even when we distribute the profit. And we distribute the profit in term of dividends. A reserve, and we can distribute the reserve. Reserve can be retained earning the previous year profit. If we don't have even profit this year, we can pay dividend from our previous year profit. So that's why we never ever, all distribute all the profit of the year. We not distribute to the shareholders. We'll try to keep it, and we'll distribute the fixed percentage of dividend, or we'll carry on. We should have a consistent policy of the dividend. So non-distribute reserve like share premium and revaluation reserves can be. Okay, then we have a loan. We can raise money through loan. Always, the lenders check, what is our current position as a business, how much we already borrow. We can afford it to pay back. We prepare all these accounts under IAS 1. IAS 1 is called International Accounting Standard 1. And we earlier discussed as well 4 types of statement we prepare. Statement of financial position at the end of the period, statement of comprehensive income, statement of cash flow, and statement of chain equity. So fair representation, the fair value of the asset. We like if we have a Windows 98 series at the moment, Windows 98 really people not going to buy. When we bought it maybe back in 1998 or 2000 or £300 per CD per software. So if we are telling people now is this CD worth is still, so we are not telling the truth. And the fair value mean the market value of the, so that's why we need to be make sure we always do and we record the transaction on the fair value, whichever is the correct, to tell the true and fair. Okay, so going concern meant by the business will carry on as doing normal operation. Next, within 12 months, they're not going to be liquidated. So that's meant by going concern. Accrual basis, each year income and expenses should be shown in the profit and loss. So if you're paying advance insurance for the next year, so that's not expense. If you treat expense in the profit and loss, that mean you're not telling, because this is the prepaid. Prepaid is our advance paid. If you're paying advance something, it's still not your expense, so we need to be very careful when we prepare the account. Materiality means significant. If your one transaction is a £1 million of expenses you keep off the account, so it means the materiality we can't, because that can be huge. So we should show all the material information. Offset asset and income and expenses should not be offset unless they is required and permitted by the standard. So consistent presentation we need to be, we follow the same layout, same costing principles. Okay, so our balance sheet, statement of financial position can be look around where we can asset, a non-current asset means long term. Then we have a current asset, which means short term within a year's carry on, like inventory, trade receivables, and cash. Any question if you have, please, you can ask, either you can chat as well. Okay, then next sorry?
Can you in detail about balance sheet and non-current and current assets? I have a bit of confusion in those aspects.
Okay, no problem. So balance sheet, we have 2 types of asset. One is called non-current asset, like property, plant, equipment. Those assets also known as a fixed asset. Those we can use more than a year. So the asset which can be used more than a year is called capital asset and capital investment in the business, and those are treated as a non-current asset. And asset, the definition of asset, anything you own it which will flow the future economics benefit we call asset, which you can do the business with it is your asset. Then asset two categories, non-current, long-term. Normally we borrow loan for the long-term asset to buy long-term like building, machinery, plant. And the short-term asset is known as current asset, which is carry on changing like stock. Stock never stay the same. Each year it can be its value carry on changing. So that's the inventory. Trade and other receivable. If you're selling things on credit, your receivable carry on fluctuating and your cash balance carry on fluctuating within a 12 months. So these are called current asset, also known as short-term asset. You're not using forever and their balance not stay the same. But the fixed asset, which is non-current asset, that can stay the same. And the depreciation we calculate based on the non-current asset. Is it okay? Any question?
Yeah. And what about balance sheet?
So assets are the part of balance sheet. Asset shows in the balance sheet, and the balance sheet, these are the historical figures where we can see how much worth of the asset company own it. Okay, we'll see the actual company statement now in a few minutes, and we'll go through further slides as well. It'll be clearer. Okay, then we have equity. Equity mean the share capital, which is mean investment in the business, how much worth of shares company issues to the public. So that is share capital. Then we have non-current liability, which is mean long-term. Liability mean the legal obligation. By law, we have to pay. So legal obligation, which we have to settle within 12 months. Current liability, which we have to settle within 12 months, and non-current, which is more than 12 months. So that's the key difference between both are liability, both are the legal obligation. By law, we have to pay. Okay, so if we have total asset minus our liabilities, if we take out the figures from the asset, our liabilities, we say net asset, and net asset figures always equal to our capital. Like if you bought a house 150,000, 50,000 you paid the down payment when you bought a mortgage. So rest 100,000 is your loan. 150 minus 100, which is, so you can say 50,000 is the investment, or 50,000 worth of the house you own it. Rest is a bank own it because that's the liability still against the house. Is it okay? Hello.
Yes.
Okay, brilliant. Okay, so next we can look around. Yes, all being explained here as well in further current asset, non-current. Next slide. And then we have a revenue, which we call income statement. So always we prepare first income statement and then we'll prepare balance sheet, because the profit for the year is also part of the capital, because the retain earning, the earning which we not distribute to the holders, we can retain it. And then if we need to pay the dividend to the shareholders, we pay from the retain earning. Okay, so always revenue mean the sales turnover, the worth of sale, how much it cost us, and then we have a gross profit. Then we have overhead expenses, we call indirect expenses, and we minus all these like a distribution, admin. Then we have a finance cost, mean interest on borrowing, tax what we supposed to pay on this, and then we have a profit for the year. And that profit is not mean the cash, it can be credit sale also is part of the profit. Then we have other comprehensive income. Those are not our routine business. Sometimes we have a gain on the property values, so that can be an income, and we can pay the capital gain tax on it. Okay, then we have other comprehensive income, profit less expenses, other comprehensive income, and then we can say, and which is part of equity figures, which we can prepare under the chain in equity. So we can say how much was the start of the year share capital, reserve, retain earning, total equity, how much during year, other comprehensive, how much income we have during year. And then if we paid dividend, we minus dividend those, and then we can calculate this way, So this way we can calculate total end of the year, how much worth of the equity. Net asset always equal to equity. If you know net asset figures, it means you know your equity figures. So that's, the equation we call accounting equation. Assets equal to equity plus liability. Asset minus liability is become net asset, and net asset equal to always equity figures. So this is the way we can prepare our accounts. And user of financial statement, yes, there are the number of users, depends, what purposes. HMRC in the UK for the tax, they look around account for the tax purposes, we are paying right tax. Shareholders always, they're quite keen to look around, we are getting the dividend or not. And others, the financial institutions, employees, and various other, they also want to check, the company's earning profit. It means their jobs not at risk. So that's the crucial. We need to look around. External stakeholders can be internal, external, and we calculate various ratios. Ratios is the financial ratios. Thus we can interpret and we can make the decision either to invest in this company or not. That's the financially viable or not. That is a crucial which we need to carry on. So which will go through some financial ratios. We already explained non-current, current asset, current liability, non-current, long-term, short-term. So next we can look around. We have a company called Next and Marks and Spencer, these two companies. So what we can do, we can copy these links, the financial statements, and we can look around what's happened those years in their financial statement. Even we can compare. So income statement consolidated, which is on page 115. So I can simply type 115. Yes, so here is the statement of comprehensive income. We'll see what's happened next during that period, and the next 52 weeks back in 2018 and 19 figures will compare, and you will see there the profit is dropped, and you can see full picture of consolidated. Consolidated means they have so many subsidiary companies, so that's why we can prepare as a group statement. So we have a total revenue. We'll see their revenue went up. Then we have a sales, cost of sale. We have a gross profit, and then we have other expenses, and we have a profit before tax, profit after tax. We'll see there the profit this year is dropped instead of increased. We can see here how much dividend they paid. That's also give us indication earning per share. So the shares we have 435.3 pence per share. The earning is not mean we'll pay all to the shareholder. Then we'll pay the dividend from our retained profit. So this is all about then we have a balance sheet. You will see the non-current assets, how much worth of last year, this year, so we can compare. Then we have a total assets. Then we have a total current liabilities, and we'll see here, and we have a net asset figures. They minus the liabilities, and net asset always equal to the equity figures. Equity mean the investment in. Then third statement is we prepare the cash flow statement. Same way we can look around. This is the change in equity. Equity mean how much dividend or shares we issued or paid during the year. So at the start of the year, how much return earning, how much total equity figure was. During year, whatever happened, that was 20. Even they gave 2017. That was 2018. Okay, that was at the start. So we can look around during year how much dividend we paid. So shareholders, sometimes they buy the back shares and they can issue more shares. So at the end we have equity figure this, yes. So that's shows all about the last year total worth of equity, yes, and this year worth of total equity. So we'll see. So that's the way we can look around, and we can the same figures equity will be part of the balance sheet as well. So then we have a cash flow 3 heading. We can look around operating, which is my normal business, day in and out. If you have a spare cash, you can invest in different assets and you can generate profit out of it, inflow or outflow the cash you have. And then you have a financing activities, you borrow money and you can say how much net increase or decrease in the cash throughout. So last year cash balance was 8.5 million. Now we have a 34 million. So it means closing balance this year is more than the last year. So cash position is improved, which is a good sign as the employees and the investors as well. Any question? Sorry, dividends?
Yeah.
Okay, so we can see in the cash flows. Our cash we paid as a dividend 215.7 million, and the last year we paid 479.7 million. Yes.
Dividend is the amount of money you pay.
Yeah, that's the amount of money next paid to the shareholders. The cash went out of the business. Yes. So if you want to go back and you can look around in the statement of change in equity as well, which shows.
Okay.
So that's, there is all the explanation. Yes, dividend note 7 you will see here. Yes, and that's all, which explain how much. Yes, you can see the per share dividend as well, how much they paid. So there will be the separate note for dividend. So if you type here dividend, yes, and you will see the dividend. You will see here, yes, group increased by 4 point. So they paid dividend. So they paid 110 pence per. Yes, so and this year they paid 165 pence per share, which means £1.65 they paid. So there is an increase about compared to the last year, which is a good sign for the investors. Okay, that's the way we can look around in the financial statement, and all we can look around the Tesco. Then recommendation and the decision based on the evaluation using the ratios, which will go through the ratios, and basis of this we can decide which company will go ahead and will invest. Ratios is used a simple calculation. We have 4 types of ratios which we calculate and we make the decision. So first we have a profitability ratios where we can look around how much company earn the profit, and what is we want to see the return on capital employed, how much worth of the asset we have and how much the worth of the return we have, profit from operation. We can look around the profit, return on total asset, how much worth of the company hold the total asset, and then how much profit. Because like in the hospitality industry, especially in the food, the people say the 400% profit because the food business is always good. So we can say what business you are in, we can compare with how much worth of asset you have, worth of building you're using, and all bit and pieces. So you need to be always look around. Return on equity, we need to look around the profit after tax divided by total equity times gross profit percentage, expenses and all. And these are all the ratios we can calculate, and these are all come under the profitability ratios. Then the second type of ratios we have liquid. Liquid means that's cash or any asset near to the cash we call liquid. A liquidity ratio. Current asset divided by current liability. Normally is £2 worth of asset and £1 worth of liability is a good sign for the business. And then we can look around the quick ratios, because inventory sometimes people not buy or the stock can be outdated. So we can take out the current asset minus take out the inventory figure divided by current liability. So we can calculate these ratios, interest cover ratio, gearing ratio. Gearing, if you drive a car, high gear, high risk. So if the ratio is high compared to the previous year, will be higher risk. Use of resources is known as efficiency ratios as well, how efficient our business is, and we can calculate all these ratios, which we have calculated some here. Any question? Okay, so these are all the formulas.
Yes, if you can give me an example of liquidity ratio.
Yes, liquid, like if the company's current asset cash, a receivable, the money we have to receive from different our customer because we sold the goods on credit, and plus inventory. So if we add them all, those will be our current asset. In the balance sheet, all the current asset figures always given. Then you divide it by the current liability. Short-term asset divided by short-term liability. So our assets should be more than our liability, then your business is very sound. If the ratios come 2 to 1, it means £2 worth of asset and £1 worth of liability. We have like £2 worth of receivable and cash you have in the business, and you have to pay £1 to your creditors. So it means you have 2 to 1 ratios, and 2 to 1 ratio is a good sound. So if the business will next year due to the economic or COVID or any other situation, so we're not going to be liquidate quickly, going to be bankrupt. Huh? That's a secure investment if we want to invest it. That's all the liquidity ratio, which we'll see now some examples in the next slide. So these are all the formula we've been given, all been explained. I'm not going through in detail, but that's the formula. Like here, we have a two companies, gross profit ratios, gross profit divided by the sales. Sales means the revenue. So this is coming 45. We have a two companies, Anika and Papika. So we have two companies, and they're all there. We have a handouts as well on Moodle. So 16,200 was the gross profit in that year, and the sale was, so 45% they have a return. And other companies, the 52% they have a return. So which one we think is the better to invest? 52 or 45? Hello, can you hear me? Okay, so we need to.
Yes.
So in
What
this,
were you asking?
we can look around, the ratios. 45 is came the gross profit ratios, Anika, and other companies, Papika is came 52.5. So we better off if we invest 52.5 according to the gross profit. Yes, because we have a more profit in Papika compared to the Anika company. So we use the ratios and the figures we got from their financial statements. And then we have a second, profit from operation. That's 9%, another is 11%. So 11% is the better. Then we have a gearing ratios. We'll see here. Total debt divided by debt plus equity. That's the formula for, and that's 13%. That's 70. So Papika is more risky company because the higher gearing mean high risk. It means the company borrow a lot of money from the various, the banks and various institutions. And then alternatively, 15.29 and 245%. This is about Papika, so which is very risky company. They have, so
that means the profit is good or bad?
Yes, so it means, they borrow more money than their own investment. They have a less their investment than the borrowing money. So if they don't pay the interest or they can't afford it, they will be bankrupt. Yes, 245% they borrow it against 100% of their own investment. So if you have £100 your own investment and you borrow £245 from someone, yes, so which is a huge. So that's why it's not a good. It's very risky company. It can be dissolved. It can be liquidate any time soon. Yes. So that is a not good.
Okay, liquidity means that the company will be dissolved.
Gearing mean the high risk. We're not looking liquidity. We're saying liquidation. Liquidation mean the bankruptcy. Yeah? Going to be bankrupt if you can't afford it. This is the liquidity ratio. This one is asset test ratio. Is a part of liquidity ratio, or we call it quick ratios. This is CAM or 1.2. It means the asset is 1.2 pound worth of asset. Those are most liquid. Liquid mean near to cash. So 1 pound 22 pence worth of asset and 1 pound worth of liability. it means their asset is more than the liabilities, current liabilities. So this is a it's a good sign because they have a more asset than liability. But if we look the Paprika company, they have only 65 pence worth of asset against £1 worth of liability. So they £1 they owe, they have only 65 pence worth of their own asset. So which is more risky? Yes, they have a less liquid asset which is near to the cash. So that is more. If we look interest cover ratio, their profit in Anika 11.6 times higher than what the interest they have to pay. So bank is happy to give them more borrowing to Anika compared to Paprika, because Paprika company, they have two names, 3.1 times they have a higher. So if they drop next year 3 times, their profit drop, so they really can't afford it to pay back the interest to the bank if they borrow money from the bank. Any question?
Right, I understand. Thank you.
Welcome. Okay, so that's the way we can look around, and basis of this, we can decide, and the analysis we can use. We can look around the industry averages as well to compare which company. We can look around the company's strategy, what their strategy for the future, their action plan, what they want to, and then we can decide, investor help to determine whether to buy or hold. So these are all the user and what decision and what information they are looking and what decision they are going to make based on the ratio analysis. So that's all interpretation. So according to this, so gross profit, Paprika is a better, operating profit, Paprika is better, gearing ratio is less risky than Nika, interest cover ratio is less risky, asset test ratio. So as for the profitability, Sun is a better ratio found Paprika, and Nika has profitability ratio, while it's not a good Paprika to be perfectly acceptable. So these ratios show that Nika is in the light in the term of the level of debt and ability to meet the interest payments, solvency level, and Paprika interest cover is a lot worse. So it's marginally acceptable. But two of these ratios show the dangerous and low level of liquidity, both which point to the high risk. In conclusion, we can look around which company is best. So we are saying you Anika is too good to be invest because this is the less risky. If you're happy to take the risk because the Paprika maybe can't afford it or maybe not give you a penny return, the reason is because they are already borrowing a lot. So on the basis of this, our calculation, we have made the decision to be invest in Anika, not Paprika. So that's all, Any question? Okay, so today lesson we discuss about financial ratios, 4 types of ratios. We discuss accounts, and we look around the actual company's accounts, and on the basis of this we can make the decision either to invest or not invest in any company. So that's all today. Anybody, any question, please? If you have any question.
No, thank you.
Okay, thank you.